My discussion today is about about cost segregation. So what I plan to do is cover what cost segregation is, the advantages, the disadvantages, and some client experiences that have taught me some things as it pertains to cost segregation. First of all, what is cost segregation? It's nothing more than a method of depreciation. Of course, the principal advantage is the acceleration of the deduction. All right? But it makes me as a planner think, if I can accelerate the deduction, can I use it? And for people that are familiar, of course, with the various aspects of real estate losses and the ability to deduct them, the least able to deduct generally are the passive investors, followed by active investors, and ultimately the holy grail of real estate is the qualified real estate professional. So laws are passed generally, and the specifics come with cases that are in it. And there's no case on anything other than the theoretical proposition that 1245 could be recounted. So I tend to minimize that as a risk with respect to the sale and or the exchange.
2 years ago, this March 17th, ladies and gentlemen, the IRS released the temporary tangible property regulations. They will be making them permanent at the end of this year or after the first of the year. So we've been producing studies called asset valuation studies in addition or concurrently with our engineer-based cost seg studies. We have two catch-up conditions, and Bob has alluded to one of them. On the cost segregation is any property after 86, meaning in service since January 1. And we've done studies on properties that have been actually 50% of the straight line depreciation has already been gone. There's still a nice catch-up condition. The second catch-up condition, which I'm going to be talking about, tangible property regulations, what are they? They are, in fact, any kind of improvement since the genesis, since the beginning of service, that you've had your properties placed in service. Oftentimes what goes in has to come out. So what comes out, the operative legal term is disposition, disposal. And the way it's written currently, it may change, the catch-up condition is only in tax years 13 and 14 on what you've thrown in the dumpsters since the beginning of time. And this not only includes 1245 personal property, this includes 1250 property. So, and there's a value on what was thrown in that dumpster. And my CPA friends, with all due respect, do not have that number that was thrown in the dumpster. But by God, we do have that number, and that's what's important. Now I get to attack 1250. I've got a family here in Seattle that specializes in parking, and I could never attack their garages because it's all structural, it's all 1250. Now I'm attacking roofs that in fact they've replaced years ago. And I'm doing one up in Anchorage right now as we speak. And there's an extra write-down condition because they replaced that roof 6-7 years ago. But here's just some quick examples of some components. And these are the more expensive components, if you will. Lastly, good example, I won't mention any names, CCIM-WA. I did a $1 million apartment building in Bremerton. I did a cost seg study on. He spent 90 grand on the windows. He disposed of them, he threw them out. We got a $45,000 rebate from Puget Sound Energy, so his net cost so far is about $45,000. We ended up putting a valuation on those old windows because they were disposed of, and it turned out to be an extra for he and his cousin. Another $45,000 write-down condition on top of the cost seg study. It only cost them $1,800 to get that little study done on the TPRs.
This afternoon, we're going to talk a little bit about 1031 exchanges, and my sense is that they're sort of refreshed and reinvigorated based on some recent changes in our tax laws that make them more valuable, in my opinion. We'll go over just a recap of some of the basics of 1031 exchange and some of the issues dealing with entities in 1031 exchanges. So the income tax changes, we maintained the tax brackets, the 10, 15, 25, 28, 33% brackets. Those all stayed the same. So that was the extension of the Bush tax cuts. However, the top tax bracket increased from 35% to 39.6%. And so that new bracket starts at $457,000 for married filing, joint filers, and $400,000 for single filers. And of course, if you've got a large property sale on a tax return, you can start hitting those top rates pretty quickly. In addition, we see some changes in the long-term capital gain rate. Of course, a long-term capital gain is the sale of a capital asset that's held for a year and a day. Not just 1 year, it's got to be a year and a day. And you get the long-term capital gain rate. And that rate is retained at 15% except for high-income taxpayers. So I think you're probably seeing a trend here, high-income taxpayers. They get a new 20% tax rate. 1031s are more valuable now with higher tax rates, and with our step-up in basis rule upon death. Really encourages people to continue deferral because tax rates have gone up. And so 1031, I think, is refreshed and revigorated, and there's some things you can do. Many properties, of course, are owned in LLCs and partnership structures. You can still do 1031s with a little bit of fancy footwork and try to make everybody happy. People who want cash, the people that want to continue. There are ways you can arrange it if you think thoughtfully in advance and plan, utilizing the tenancy in common.